Let's talk more about what this means for your portfolio today. Lizanne Sonders joins us. Charles Schwab, Chief Investment Strategist, joins us this morning. Lizanne, good morning. Great to have you back.
Thanks for having me, Carl. Nice to see you guys.
Do you trust these PPI numbers so far?
I don't think there's any reason not to trust them. I think these days, any inflation data, and I would actually spread that to labor market data, I think the details are at least as important as the headline, and we're in that mode where I think you really have to dig inside the details. The portfolio management fee piece of it, which does map to the Fed's preferred measure of PCE, unless we continue a melt up at the same pace as what we've seen in the past couple of months, that will start to ease in terms of providing that upward pressure. But to the point of the conversation you guys were just having prior and some of the things that Sarah said, what we have to be mindful of is the possibility, maybe not likelihood, but possibility that what we're starting to see in producer prices ultimately to a greater degree gets passed on to consumer prices.
Right. What do you think explains the action in PPI services? Is it just a notion that if we are subject to any kind of tariff-related inflationary pressure, that everyone will use it as an excuse to raise prices even if they're not exposed?
Well, you actually, Carl, are hearing that from some companies, both companies that are impacted by tariffs, but not necessarily across all their product lines. Many companies have said, we are likely to pass on higher prices beyond just those goods or inputs that have tariffs associated with them. There have even been some companies, and they tend to be on the smaller end of the spectrum, that said they would take advantage of an environment allowing them to increase prices, even if they're not directly impacted by tariffs. But I think every company is trying to figure this out. You know, this whole narrative around the impact on inflation being one-time in nature, a price level reset. The problem is that tariffs, their implementation when they kicked in, has not been one-time in nature. It has been, you know, on and off and back and forth. So just by virtue of that definition, we're unlikely to see that one-time impact. This is going to be an ongoing process, each individual company figuring out what, if anything, they're going to eat in their margins and what they can pass on.
I mean, here's the thing. The market is at a record high and is brushing a lot of this off, whether it's going to hit the margins on earnings, whether it's going to hit consumer price inflation or wholesale inflation, or the market is glass half full about tariffs right now. Is that right or wrong?
Well, it is at the index level, but it's driven by the mega cap names' contribution given their size. If you look at participation under the surface, you saw a nice pop from a breadth statistics standpoint yesterday. But prior to yesterday, you were kind of in middling territory in terms of the percentage of stocks trading above 50-day moving averages, 200-day moving averages. If you look at participation, you know, tech, which has been a leadership area, notwithstanding yesterday, had only, you know, 50+% of stocks trading at trading above 50-day moving averages. You only have about a third of stocks that within the S&P 500 that have outperformed the index itself over the past 1 month, 2 months, 3 months. So I think what we're seeing is similar to what we've seen quite a few times in the last couple of years, sort of churn and rotation under the surface, and that under the surface activity may be more reflective of some of these tariff-related concerns, fundamental-related concerns. You just have this concentration impact that means you get the sort of the index gets flattered by virtue of the narrowness into the mega cap names.
Right. On that front, how healthy do you think this run is in small caps? Is it sort of about Fed cut vaporware? We've had some instances in the last year where you got a little squeeze on the Russell and then kind of had to pay for it.
I think probably the index that is most closely short-term correlated to expectations around Fed policy would be an index like the Russell 2000. You certainly saw that reflected yesterday, and frankly, seeing that reflected again today. Because the interesting thing that happened in the aftermath of the PPI being reported is you didn't see the needle move much in terms of expectations for a 25 basis point cut. What shifted was a move from maybe, I don't know, 6 or 7% expectation for a 50 basis point cut yesterday. That's now been wiped off the table. And that percentage has kind of moved back into the flat. Fed isn't going to do anything camp. But I think yesterday was an example of a day where, because expectations were very high that the Fed would start to move, and they probably still are in September, that provided some lift to small caps. The problem is you still have 40% of the Russell 2000 that is some combination of not profitable and or zombie companies, meaning they don't have sufficient cash flow to pay even interest on their debt. And I think that will continue to be the more fundamental plague impacting at least some of the Russell 2000.
So do you like the broadening out trade or not? What would be your advice to folks with index levels, as you say, at record highs, distorted a little bit by big tech?
I think that there is opportunities outside the mega cap names. In fact, you're seeing that in performance. If you look at the 10 best performers in the S&P 500, none of them are in the Magnificent Seven. If you look at the 10 best performers in the NASDAQ, they're all small to mid cap stocks. They're not the mega cap names. That's suggestive that there are opportunities outside those sort of high profile mega cap names. I think the way to find them, especially within the sea of small caps, inclusive of really low quality names, is to stay up in quality. When you've got that 40% that are zombie companies or non-profitable companies, don't lean into that non-profitable trade, which has, those baskets have done well off the early April lows. But I would say fade the low quality aspects to this rally and lean into higher quality. That's where you tend to get some ballast, especially if you go through another period of pullback or volatility. You may not get the most of the upside if the market continues to move higher, but you have a little bit of that protection by virtue of staying up in quality. So that's been particularly how we say you want to navigate within the smaller cap universe.
Yeah. Sometimes they say play the components and not the index.
Right.
It's going to get really interesting going into tomorrow, too, Lizanne. Thanks so much. Talk soon.
My pleasure.